Hello friends, the biggest crisis in 2023 was the failure of SVB Bank and Signature Bank and the voluntary closure of Silvergate Bank and some of the stress that has been building up in Credit Suisse Bank in Europe. So these combined impact of these failures and the stress that has been built up has impacted the stock markets, and many people have lost a lot of their precious wealth in the stock markets because the stock markets have fell very sharply because of these events that have impacted the markets. Now, when we lot of literature has been developed, and everyone almost in the financial sector knows why SVB Bank had to face such a failure when it was a very good bank. It was the 16th bank, and Forbes has adjudged it as the best bank in the last 5 consecutive years. So it's a good bank, opened in 1983. And it has been working for last 40 years very efficiently, and only in 2000 and 2022 during the pandemic time, this bank, which was targeting the startups and tech companies, have seen a huge inflow of deposits during these 2 years, and they did not have that much of capability to lend to the borrowers, as a result of which the out of 212 billion asset size, 74 billion was in credit, and rest had to move to the securities market. And securities markets were at that time having very low interest rate, because in US it was a near zero interest rates, and many of the economies have brought down the interest rates, provide relief to the victims of the pandemic, and many liquidity windows have been opened by the central bank, non-conventional windows, so that these sectors which were suffering were given some kind of relief. And the government was also providing a lot of stimulus packages to various sectors of the economy, as a result of which 2 things have happened which everyone knows. First, the interest rates have been lowered to the bottom, and the liquidity system was flush with funds, and as a result of which the easy money policy of the central banks had started flowing into the system. And every bank which was operating in the system was aware about the consequences, that when interest rates were going down, the interest rates will also rise at a point of time. And when the lot of liquidity has been pumped into the system, there will be absorption of these liquidity at some point of time. So it is not that nothing unusual has happened, because when the pandemic started receding and all the economies were struggling to come back to the normal, suddenly the war between Russia and Ukraine in February 2022 has come as a very big shock, and it has added to the challenges that the central banks and the governments were having at that time. And as a natural sequence of events, because of the flush of liquidity in the system without corresponding goods and services, the inflation had gone up, and many of the countries have seen a 40-year high interest rates at some point of time in 2022, and central banks had to fight the inflation and have started raising the interest rates much faster than anybody could anticipate. And very quickly the US interest rates have started going up to 4.75. And even in India, when we have seen a 4% interest of repo rate is having now 6.5%, and there is a liquidity absorption by the central banks to curb the inflationary trends. Now, in this kind of a situation, it is natural for many of the banks to face asset liability mismatches. But my point is, were these situations not anticipated by the strategists of the bank. There could have been some kind of strategies put in place and some kind of precautions, some kinds of stress testing should have been done to prevent this kind of a collapse of the banking system, because the problem with the collapse of banks are the collateral damage is much higher than the damage caused to the bank. Because if you take the example of SVB Bank and Silvergate Bank or the other bank which has fallen, Signature Bank, the depositors have been protected. So they may get their deposits back in due time, but the collateral damage that has eaten away the what we call the wealth of the investors, it is very difficult for it to come back again to the normal course. So my point is, the banks and the bank strategists, that is the planners in the bank, should be very well aware that when the interest rates were falling, the interest rates will rise. When a lot of money is there in the system, inflation will also rise. And suddenly, because of the outbreak of the war between Russia and Ukraine, naturally there will be some kind of disruptions in supply side disruptions. There will be a lot of restrictions imposed on the US, the sanctions against Russia by the European countries. These will always have some kind of repercussions on the financial system. Now, anything that has happened which should not happen, if you look at the way in which the various economies were moving in the last 1 year in 2022, the sequence of events were almost the way they should happen. Like interest rates which have fallen to a low will gradually rise to fight the kind of inflation that has surged because of the more money in the system. Everyone knew that when the interest rates rise, the yields will fall and the gains will lower, and the revenue streams that are coming from the investments will also come down. So these are all some of the things which are in the knowledge of policymakers. And I think if you drill down into the mechanics of SVB Bank failure, I think somewhere the bank should have put some kind of a cap on the inflows of deposits if they are not able to manage their credit growth, or if they are not able to manage the pricing strategies, risk-based pricing, or maybe that they should have gone for a negative rate of interest on deposits, so that it will dissuade people from putting money. Or in terms of size, there should have been some kind of a cap, which is not normal. I don't say that it is a normal phenomenon to do that, but in unusual times, unusual strategies are required. And maybe that some of these measures could have prevented the build-up of ALM mismatches to the extent they have been there now. Perhaps that could have come down, and maybe some kind of fallback mechanism could have been built, and this kind of a failure, sudden failure of the institutions could have been prevented. Now, taking a cue from what has happened in the financial sector, mostly in the banking sector, the banks have to now take care of the business mix, that is the assets and liabilities. Now, when we see the assets and liabilities, it is not only the amount of assets and liabilities and the gaps, but what is more important is the maturity profile, residual maturity profile of the assets and liabilities. And also we will have to see the costing, that is risk-based pricing of liabilities and assets. And what kind of, like in India, if you see the call money market going up to 6.52, that is a very high call money rates, because if some bank is to borrow from the call money market, then the cost of managing the liquidity mismatch will be so high that it will be very difficult for the bank to maintain the profitability trends. So these will have some kind of repercussions. So what is more important is to foresee what is going to come. Like now, what is more important is to see how liabilities inflow, Now liability is not always a welcome feature when we cannot absorb them in our business lines. Like what happens is money is a very hot balloon. If the money comes and if we are not able to deploy the funds, then it will burn our hands. So that is the kind of toxicity of surplus funds that come into the system. So as soon as the money comes, the deployment has to be there, and the tactics of deployment of the funds also have to be seen in a broader perspective. So taking a cue from what has happened in SVB Bank and the business models of the banks that are followed, my submission to the banks is they need to look into their granular data of maturity mismatches, and then they will have to see the granularity of stress tests, how they can do that, and what will be the pricing and how they are going to cope with that. And of course in India the bond market is not very deep, and the inverted yield curve which is affecting most of the economies in the advanced economies, that may not hit to that extent in India, and the diversity of deposit base and the size of the deposits are very fragmented in India, as a result of which we are quite safe. And that is what the RBI always repeats in its communication to the people, that relatively Indian financial system is very secured and Indian banks are very safe. But despite that, individual banks will have to plan out their strategies in such a way that the business mix and the business model that they follow and the costing pattern that they follow and the risk-based pricing that they put in place, they all should be very well planned with standby plans, so that we don't get into a kind of ALM mismatches which is difficult to cope up or which is very costly to cope up. So I think a lot of learning we need to take as we go forward. We will learn more from this kind of discussions. I would request you to subscribe to my YouTube channel and put your comments in the comment box, and it will be giving me a lot of learning points, and we will try to improve upon our discussions as we go forward. Thank you very much for being with me.